and welcome to our latest Do More With Your Money podcast. Today we are going to talk about pension withdrawals and strategies with you, the viewer, and mainly to help you and aid you with your retirement. Today I'm joined by a guest panel today. We've had all of them on the podcast, apart from one person, Carly. But we are joined by Donald from our pensions technical team, Carly from our relationship management team, and also Luke Johnson Bolton is one of our financial planners. So welcome to you all. So what we're going to do is a brief introduction to the podcast, then we're going to talk about the specific areas, but we've got some good stuff to talk about today, and we hope you will enjoy it. So we're going to talk about our pension withdrawals right for you, the viewer, and in relation to your retirement. You might have many questions around that. We're going to talk a little bit about pension withdrawals before teeing up obviously the questions and what we will hope to cover. Things like managing pensions, what is pension drawdown, long-term future planning, so you can really have a look and think about how it's going to affect you when you come into retirement, and also really a little bit about future-proofing your retirement. So first of all, a historical context on pensions and pensions drawdown. For that, really, I'm going to pass you over to and ask Donald. Donald, can you give sort of a brief background on pensions and the sort of ways in which you can take your pension?
Thanks, Neil. Essentially, pension drawdown is a way you can take income from your retirement savings. Prior to 1995, we didn't have pension drawdown, so that came into play in 1995. Prior to that, what you're able to do if you have a pension is take your money out and buy what we call guaranteed income or fixed income, which is your annuity. That's what we call that. Mm-hmm. But 95, when pension contract came in, pension drawdown, you are able to take income from your pension pot and designate part into drawdown, where you can take fixed income or as a lump sum. Now, in drawdown, that's essentially used within the concept of defined contributory money purchase scheme. Yeah. So you can do that if you have a DB pension scheme. So it's got to be a pension scheme you take under the defined benefit approach. Mm-hmm. But if you have a DC scheme, what we call the defined contributory, then you can use drawdown pension.
So really, over the last couple of years, the pensions have been more flexible in their approach.
It really has been flexible between 2021 and 2025, when we had the flexible pension, flexible drawdown pension. In 2015, it did change from flexible to flexi access pension, but the entire concept is still the same thing. So you're flexibly accessing pension within your savings retirement pot as an income.
So a lot more options for your pension.
It is a lot more income. It's a lot more flexible in terms of what you are able to do with that. And just to mention that not all pension providers actually offer the flexibility approach, which is pension drawdown pot. Yeah. So where a pension scheme do not offer that, then you could be looking at transferring out to actually get pension drawdown. Yeah. So it's so
it's really important that people check what type of pension they have.
Absolutely.
And the options available as well.
Yes.
Good. Okay, and what sort of, I think this hasn't changed for a while, but what sort of age can you take your pension pot from?
Essentially, you can take pension drawdown when you reach your what we call the normal minimum pension age. Currently, that's at age 55, and it's going to move from age 55 to 57 in April 2028. Yeah. So what that means is people born before the 6th of April 1971 will still be able to access their pension from age 55. So anyone born after 5th of April 1973 will have to wait from 55 to 57 before they're able to access that. Yeah. But for people born within the period from the 5th of April 1971 to the 6th of April 1973, there'll be a window where you are able to take it at age 55.
Right.
But if you don't take that, then you have to defer to age 57.
And is there somewhere you can check on this? Is it a government website you can generally check?
Yeah, absolutely. You can also call us as well. Just phone in or send us an email if you want to know when you're able to access that, or go to the government website and type when can I access my pension.
And obviously as well check when you can take the state pension as well, which is different, and obviously is a little bit further down the line as well.
That's correct.
Yeah, good. And Donald, there's been a lot of talk recently in the press about the potential government changes and changes in the amount of tax-free cash you can take, but how much actual tax-free cash can you take presently?
with the pension drawdown, you are able to take as much as or as little as you want to take. So that's the flexibility that pension drawdown brings into the fold. So up to 25%, you can take up to 25% of your pot tax-free. So you don't have to take it in one lump sum.
Yeah.
You can phase it if you want. So you can take it, whether you want to take it as a lump sum or you just want to phase it in between as and when it's required. Then the 75% that you have, which is the balance, you could take as drawdown income.
Okay, but you don't have to take the whole of your tax-free cash.
You don't have to take it as, so that's the flexibility that drawdown actually gives to you as well.
That's a really good point, Neil. I think historically clients have always seen retirement will take the tax-free cash and then maybe we'll buy an annuity. What you've got the power to do now is take some or all of the lump sum and leave the rest invested in a much more flexible way. So it's really important to know that you don't have to take that tax-free cash. You could take 10% tax-free cash and leave the remainder to grow, invested in a tax-efficient investment. So
What's
that's a really
what's the
important point.
benefits of, Luke, just moving on to sort of that point, what's the benefits of not taking your full tax-free cash?
Yeah, I would always say, look, when we provide advice, if there's an immediate and quantifiable need, then maybe you should take it. But if you don't need to, say if you've got a £100,000 pension pot with £25,000 tax-free cash, that pension could grow, and with it the tax-free cash could grow as well. So you're going to get that tax-free growth on the pension. Potentially there's an opportunity for more tax-free cash in the future.
Yeah,
so it's always good to speak to an advisor and say, you know, do you really need that tax-free cash?
And of course that money's still growing while it's not taken, and it is in the pension wrapper, which is a good point. And I think there's we often get it with clients, don't we, that they think you have to take your full 25%, which isn't the case, and in most cases it's left to keep invested, which is a really good point. So just sort of moving over to you, Luke, we look at, you know, we've talked about pensions being more flexible. We've talked about the options. We've talked about how, you know, pensions weren't very flexible, but that might benefit some people. So not all flexibility will benefit all clients, and it's wise that clients have their options with regards to what pensions, because some pensions won't have flexible stuff like the older schemes. But do you want to just go through what types of
so
withdrawal options you have?
Different ways to take a pension. The first option would be a lump sum withdrawal. So if you use the example before, £100,000, you take the full pot out. 25% is tax-free and the rest is going to be taxable. So 75,000 would be taxable at your marginal rate, so potentially you pay quite a lot of tax. You've then got income drawdown, so you can sort of set the amount that you receive each month, each tax year, which is maybe a more tax-efficient way to do it. Or you could do phased withdrawals. So that's when an advisor can be involved and give you advice on changing the withdrawals that you take from your pension. And with that, you could use a combination of tax-free cash and taxable income to make sure that you're a low or a non-taxpayer, especially in the earlier years at retirement. You've also got things, you know, other options. Annuities are an option now. We know that interest rates are higher, and potentially you could use some or all of the pension to buy an annuity. Alongside that annuity, that secure income, you could look at other secure income that you have, such as state pensions, and maybe bridge the gap with a more flexible solution of a personal pension as well. So there's all different types of pension withdrawals in different ways, some more flexible than others. Obviously we'll look at that as well as how tax efficient the withdrawals are when you speak to an advisor.
And I suppose it's worth, you know, saying to people or our viewers, there's a lot of misconceptions around pension. I mean, if I talk about my mother, when I'm sorting out her pensions, she seemed to think that all of her pension was tax-free and she never paid anything, and, you know, it didn't go on to our income. But obviously pension income or pension withdrawals can be taxable past your personal allowance for most people, but obviously the tax-free part of it isn't. So it's worth pointing out that it's lumped together with all of your income, isn't it? And even when you take your state pension, it's going to play. So careful tax planning or speaking to a financial advisor is really important to get that advice. So look, you talked about the different types of pension withdrawal and options that you can take. Is there any other sort of options and benefits within those types of pension withdrawals?
Yeah, in terms of death benefits is a big one. So with a personal pension, defined contribution pension, that can convert into a beneficiary's pension, which is very flexible. In essence, spouse, children, or whoever you want can inherit that pension in its current form, which is a tax-efficient vehicle. If I compare that to an annuity, you can have guarantee periods, so maybe 5 or 10 year periods where the income would continue to pay to something like a spouse, but it's not as flexible, so ultimately the annuity is normally lost on death. So the death benefits are very different, and that's something you need to be careful of when considering.
So with an annuity, you've got a 5 or a 10 year option for death benefits, but really, if you're looking at a personal pension, you have that option of receiving the lump sum of the pension. And there's two options on there, isn't there? There's pre-75 and post-75.
Yeah, it's a really good point, Neil, and a question I get a lot is the taxation of the pension on death. So ultimately it does depend on the date that you would die with the pension. If you are under the age of 75, then any income is tax-free. If you are over the age of 75, so if you die on your 75th birthday or above, then the income that your beneficiaries draw from the pension is taxable at their marginal rate.
Yeah.
So it is taxable, but you can still manage those taxable withdrawals, much like with income and drawdown. And the important point here is it's still invested in a beneficiary pension, or it can be. So any growth on the funds is still tax-free.
Yeah, so it's wise speaking to an advisor because, options like that a lot of clients won't know about. So again, wise to speak to an advisor. Okay, so we're looking at now. We're going to have a chat and a talk about planning for and managing withdrawals. What are your options when you get to that age? What are your options when you come to retire? So we've established, obviously, through Donald, that you have to be age 55, and then it'll rise up to 57 in 2028. But can you still make pension contributions, Donald, once you're in drawdown?
Yes, certainly you can still make pension contributions into a pension when you're in drawdown.
Yeah.
The flexibility of but you have to be careful in terms of the level at which you're able to make contributions actually will reduce.
Yeah.
So let's assume that if you flexibly access your pension, i.e. you have taken an income either from a flexi access drawdown or an uncrystallized funds pension lump sum, which we for short call an OFF plus. Now, your standard annual allowance will drop from £60,000 per annum to 10,000, which is called the money purchase annual allowance. So whilst you are still able to make contributions into a pension, but you just need to understand the level so you don't breach your annual allowance threshold at that point.
Yeah.
So certainly, because you're taking income from your drawdown, doesn't mean you cannot also still put money in there, because you can as you go ahead. So normally the concept of it is literally just creating it's called like a shadow port. So you have two ports. So you have the funds which you haven't taken anything from, where you are able to still make contributions into that.
Yeah.
Where you've taken an income from there, then it creates it. We normally would term it like a draw. It's like a drawdown contract, another part.
Yeah.
Where you can draw income from, so you can always still take. So where you even take all your money, you've taken everything into your drawdown port. You are still able to make
money in.
Yeah, you're still able to contribute into, and it's an uncrystallized port or a port where you haven't taken money from.
So you don't have to move all of your pension into drawdown.
You don't have to. So it's all about what you need at the time you need it. So if you don't need the money, just leave it invested. It still stays invested.
Yeah.
But the concept of drawdown itself is still taking income while still remaining invested. So you're still invested within a tax-efficient environment, and you're not taking it out. So if you don't need the money, you can still leave it. But if you need that in drawdown, you can take just as much or as little as you need, and still leave it within the tax-efficient environment as well.
Okay, it's a good point. And Luke, from a financial advice point of view, that's the whole benefit of having a review. Looking at what sort of you need from an income and expenditure point of view. Yeah,
of course, it's very beneficial, and normally at the start of the tax year, when income tax thresholds reset, it's always worth meeting with your advisor to establish are the withdrawals efficient. We look at tax efficiency as well and make sure they use all those allowances.
And what about transferring your pensions in once you're in drawdown from a financial point of view? Can you do that?
You can. There are some rules around crystallisation of pensions, so always check with your provider. But ultimately, you can normally transfer a pension after they're in drawdown,
Great. And we were looking at the benefits. We were talking about the death benefits before. But, if I move over to you, Carly, what happens to your drawdown pension when you're not here anymore?
So we have a specialised team that deal with those pension policies, and the point is that we want to provide a level of service to your beneficiaries, your loved ones that you've nominated via your expression of wish. So the team would usually reach out to your loved ones that you've nominated and kind of guide them through the process, because it's quite a big decision of what they might want to do. They can invest the funds, they can make withdrawals. We would always recommend that we book them in with a financial advisor. The service we provided them on an advice basis passes to your beneficiaries. So we'd always highly recommend they speak with an advisor, and we'll guide them through the process as best we can.
Thanks. And there's your options of greatly increased over the last couple of years as to what you can do with your beneficiary pensions. So it's really important because, a lot of clients that we speak to here at True Potential, they think that the pension can just be paid out and it's just given to them. But we've talked about the pre-75 and the post-75 taxation rules. So it's really important that people talk to a financial advisor to assess all of their options because those people might just want an income.
Yeah.
They might not want to receive, or it's beneficial for them to receive a lump sum. And if they need supplemented income in retirement when their other half sadly isn't here, it's really important that a financial advisor helps them out. So, a good point.
Just to highlight what Kylie just said in terms of nomination.
Yeah.
It's good a nomination only happens where you have an expression of wish on file. So that is, it's crucial that everyone with a pension do actually have that expression of wish on file.
Yeah.
So that's what would nominate who your beneficiaries are.
Mm-hmm.
So if you don't have that, then you don't have a beneficiary. Then that means the decision or who gets paid gets on. The trustees do have sole discretion whether you have an expression of wish in place or not. Mm-hmm. But it's just it gives a guidance, some sort of a cover so that the trustees can actually take your own wish or your expression of your wishes into consideration when they are making that decision
for your family.
For your family as well.
Yeah.
So where you don't have that, then we're talking about nominating a dependent. So it has to be the trustees that will do that. So it's absolutely key that you actually get an expression of wish in place.
Yeah.
Because what it would do for your estate, an expression of wish would do that for your pension.
Great, good
and
point.
it's super easy to set up on your client site.
Yeah.
You can do it by post, but the easiest way is to just log in and you can nominate your beneficiaries.
Yeah.
You can
And
list
it
charities
asks
and
about
trusts
percentages as well on there.
Yeah, it does. It asks how much you'd want to leave to whoever you're looking to
Whoever,
leave it to, and you can split it however you want, really.
Yeah, and that's held centrally and recorded and kept on the
That's right.
client site.
Secure on your information. Yeah.
Good. Very easy way to do it. And from a financial advice point of view, I suppose, Luke, how often should you check on your pension?
That's a really good question. I think it's different for everyone. We've had things like market volatility where maybe if there's more negative news on there, maybe some people don't like to check. I think the technology is really good in that you can check it on your phone very quickly. Some people like to check it every day. Personally, every few months, every month is fine. It all depends on where you are. If you've got a long investment time frame, you might be more willing to not check it as closely. If you are retired, I understand you probably want to check it more often. But yeah, it's always good to have that on the app there and be able to log in. I know some people like to check it first thing in the morning, so it's good to have that accessibility, and would definitely recommend that you have a look on there.
Yeah, I suppose. And if we think about the annual suitability review, where you might have not just pensions, you might have ISAs, you might have general investment accounts. It's we categorically are obliged to review that every year. So it's really important that you do so and you complete your annual suitability reviews. If not with yourself, but with your advisor, which you can do with ourselves by booking an appointment, and we do that pretty much every day. Complete annual suitability reviews with clients. So it's a really good point to not only know where you are with your pension, but to make sure from a goal point of view that you're on track. And we'll talk a little bit about the goal and the goal setting later on. But, from a financial advice point of view, we've got a team at Newcastle, so it's really important that you give us a call if you are not only thinking about coming up to retirement, but if you're also thinking about planning, if you're thinking about adding some more money into your pension, or if you're thinking about withdrawing, it's worth giving us a call and speaking to the team here at head office. So we'll put you in touch with a financial advisor, as Carly said. So really good point there. Carly, from a client sort of a customer care point of view, what's one of the most popular questions that you have coming into the team?
I think one at the moment is in relation to the lump sum allowance replacing the lifetime allowance, so it would be good to have a little bit more insight on that.
That's a really good question. It's a question I get asked quite a lot, is what's happened with the lifetime allowance, and am I capped in terms of my tax-free cash that I can take? So the lifetime allowance is gone. It's been replaced by the lump sum allowance. The old cap on the lifetime allowance, which was 1.07 million, you still have to remember that if you're lucky enough to have that amount in your pension. So ultimately, the old lifetime allowance of just over $1 million, the maximum tax-free cash you can take is 25% of that amount, which is £268,275. So ultimately, it only affects you if you have a large amount of wealth in the pension. But what it means is it's a cap on anyone that does have tax-free cash. And unless you have a form of protection in there, that means that you're limited ultimately in how much tax-free cash you can take.
And they give out those sort of protections
Correct.
quite a few years
You'll know about
in
that.
different
It'll be
types
something
of
from the
protections.
past,
And it just to add to what Luke said in terms of the lump sum allowance as well. LTA was abolished, but was also, we have another part of it, which was actually the threshold into that. We have two sides. So you have the lump sum allowance and the lump sum and death benefit allowance as well. So he's right. So the lump sum allowance is actually pegged at 268, 275, like you've mentioned. So if you're taking flexi, we talked about drawdown, flexi access drawdown, or an off plus on crystallized funds pension lump sum, that's pegged to your lump sum allowance. That's maximum you're able to take without getting taxed at all. When we talked about Carly talked about death benefit as well, and Luke also touched into that. When you're taking death benefit, that is also, so the lump sum and death benefit allowance is key, which is the second part of the lump sum that was introduced into that. So depending on what your lump sum and death benefit allowance is, that will determine what your beneficiaries will get, and you're tax free. And or whether you die pre-75, before you're 75, or after age 75, like Luke have said. So those two lump sums actually work in tandem. So the two that were brought in to replace the LTA, the lifetime allowance as we near it, on the 6th of April 2024. So those two areas. So depending on flexi access looks at your lump sum allowance, your death benefit allowance. The lump sum and death benefit allowance looks at your death benefit for your beneficiaries when you die.
And can get quite complicated. And again, that's why I think with all the stuff that we're talking about today, you should be ringing True Potential and the financial advice team if you have any questions over that. So good point, but worth saying. So if we move on to the next sort of part, we're looking at long-term planning and sort of future-proofing your retirement. So I suppose if you think about it, everybody if you've used True Potential, you can see the client site, you can see how you set your goal, you can see you can set a monetary goal on there and how you're going to achieve it, and it'll tell you if you're on track to do so. But if you looked at it from a longevity point of view, having a look at strategies to make sure that your pension lasts through retirement, and we've also we've talked about on previous podcasts as well, long-term care costs, which are expensive and are going to prove maybe difficult for the future government at some time in the future. But look, we were talking about volatility before, and we were the last couple of years have been particularly difficult. Maybe the last 3 years from a market point of view. Talk about a little bit about volatility and how we see it probably more as normal as part of a pension investment or clients' investments, and how clients can feel sort of assured with that when we're looking at the long-term performance.
I think you need to look at time in the markets. So we know that volatility as a long-term investor, it's a normal and healthy part of how markets operate, especially in a multi-asset portfolio like what we offer at True Potential. I guess we need to look at time horizons. So, you might have a goal of 20 years to retirement, but then when you get to retirement at maybe age 60, you've then got maybe a long term to outthrow your retirement as well. If you look at the average life expectancy in the UK of 84 for a male, you've then got maybe 24 years from 60. So you can have quite a very long time period in which you're going to remain invested in a goal. So actually don't be too concerned by short-term volatility. We know that it is time in the market, not trying to time the market with something like a pension.
And I suppose as well, clients may be affected and swayed by a lot of things. You may see, bad times on the news, in the media. You may see wars. You may see, markets. We had a particularly difficult time in the Japanese market a couple of months ago, and that sort of, made the pension markets a little bit volatile and the investment markets a little bit volatile. But, you have growth on top of that, as Luke's just said, and over the longer term, whatever your goal may be, 20 to 25 years, these are small bits of time within your investment journey and your investment goals. So it's wise that if you are concerned about particular periods, then you give us a call, and we'll discuss volatility and how it's a normal part of the investment process and journey as well, obviously in relation to a longer term, which is probably your pension, and it's obviously going to give you that little bit of peace of mind on retirement. So it's really important that you speak to us if you do get concerns over that. So we've talked about the long-term approach. It's not just a pension though, is it? You've got other forms of investment that may have particular tax benefits, or may have other particular ways to invest. So we've got things like, you've got another pension, which hopefully everybody has got coming to them, which is the state pension. That's obviously part of your income as well. Luke, what are the sort of different points of or types of income have you got coming?
Yeah, it's really important to look at, I call it zones of retirement. So a typical client might retire just before state pension age, and then their first zone, therefore, they're going to need potentially a lot of money from their assets before they reach that first zone. And then they've got the state pension coming in, which is going to provide them with a secure level of income. That means they can draw less down from their assets. We can look at how to be tax efficient there, because the state pension is probably going to use the majority, if not all, of their personal tax-free allowance at that point. You then might spend less as you get older. You might have things like rental income or maybe other incomes coming into payment in different years throughout retirement. So it's really important to sit down with an advisor, plan out the zones, look at what you need, because it's likely that you probably need a lot more when you first retire, and then you can reduce that back. And an income drawdown's perfect for that.
Yeah.
Being flexible and being able to change the amount that you can take.
And I suppose there's a lot of things that we take for granted here at Working at True Potential, but do you want to just sort of talk about a little bit about what is secure income and what would be an example of non-secure income? So I suppose invested into a personal pension that wouldn't be guaranteed.
Yeah, so guaranteed income would be things like the state pension,
yeah,
maybe an NHS pension, which is a defined benefit scheme.
And that's the thing which is guaranteed
for life. That's guaranteed to pay and protected to be guaranteed, and you know that's going to pay a set amount, hopefully increasing in line with inflation every year. Mm-hmm. You've then got non-guaranteed income, so that can be things like a pension which is invested in markets. We know what you can take from that, but of course that's not guaranteed, and that could change.
Mm-hmm. So it's really important to view those in different sort of secured and non-secured, I suppose, which is good. And obviously people will have different levels of state pension, but you know there's an example down there, like you said, you could have rental income from a couple of properties, which isn't guaranteed, you know, because you might not be renting it out, but it's still classed as part of your income, and all adds to, you know, managing within that personal allowance, I suppose, which is good point. So yeah, it could be difficult to manage your income streams, you know, be it from a state or be it from a personal pension, or be it from rental income. So that's a good point, Luke. And Carl, if you were to want to inquire about that and how much tax you're going to pay, how would you make an appointment with a financial advisor?
Yeah, there's a couple of different options. So you can give us a call, but there is now an option on your client site to get booked in. So it gives you the options of what kind of appointment you might want to discuss. Mm-hmm. It'll ask you for some potential additional information that advisor would need, but it's fairly straightforward. You can just log in.
You can just log in on your mobile and pick a time and a date?
Exactly, yeah.
Great.
And it'll send you the confirmation, and then you join the call, but that's a video call on your site as well. Yeah. So it's really easy. You're not having to kind of go to an external app or anything like that. Yeah. It's all done within your client site.
All done within the True Potential technology. Really
exactly.
Good, really good. Now, we talked about annual reviews earlier on, and we talked about the benefits of maybe reviewing your pension every year. We've talked about the importance of the ongoing review. Carly, how does the annual suitability review come up on the technology?
So it's pretty obvious. It's a big blue banner on the first page that you log in, and it kind of explains, you know, the annual review is due. You just click on the button that says start review, and it takes you through some fairly straightforward questions, but we've just kind of improved it recently, so there's a lot of good stuff in there, but it'll ask you some questions about any changes that you've had over the last 12 months, just so we can understand what's going on separately, and we can then advise or recommend you speak to an advisor. But within that review, there's also elements of kind of the projection for your long-term goals. You can amend your goal, you can change it at that point. There's options to set up a regular contribution into the plan if that's something that you wanted to do. Mm-hmm. But it takes you through everything we've discussed in terms of it'll have an element on beneficiaries if you haven't got one set up, but it pulls together an action plan at the end, which you can then decide whether you want to speak with a financial advisor, but the action plan is there for you on your site to kind of go through, and based on your answers it'll kind of project what next steps might be best for you to manage your funds with us, I suppose.
And then depending on what it could be, the changes, so if you did have a change, you'd have that reviewed by an advisor.
Exactly, yeah. We'd get in touch. You can either book it straight away when you're on the site, or we'd get in touch to say, you know, these changes have flagged up as a duty of care. We'd like to get you booked in. Yeah,
and that's the whole benefit, isn't it, of having that annual review, to make sure that you have any changes and we help you make those changes. So people may have life changes, such as they might want to retire a little bit earlier. Yeah. They might want to change that goal to achieve it within 5 years less, for example. So really important that you speak to one of the advisors and get that annual suitability review finished and help with the advisor. So that's really important.
And I suppose, sorry, I was just going to say, if there are those changes, it's not worth waiting for your annual review either. By all means, just get in touch throughout the year, and we can obviously help as and when.
So any life changes really you can discuss with an advisor, because it's important. You're thinking, well, I want to do something now, but I don't want to wait until my review is up. So
exactly.
Really good point. Okay, well, that's all from today from the team. I hope you found it useful. We've been through a lot of the things about pension withdrawal. We've talked about planning and managing withdrawals, and also future planning as well. So hopefully you found the podcast informative. If you have any questions, you can email us in or give us a call, and we can answer those questions for you. We do have a blog, What is a Drawdown Pension, available on our website, so we would encourage you to watch that as well. But from me and the team, thank you for watching, and we hope to see you soon.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.